Good morning, welcome to the Market View for Tuesday the 17th of June 2014. Starting off with the 30-minute chart, you can see yesterday the market making a big move in 30 minutes up to the 170 resistance. You will also note that the bar following is narrow in range and the volume is far greater. So we see the selling coming into the market and then the market then reversing and moving lower. This is a tactic designed to suck people into thinking that the market is going to, now it's hit 170, break through. And generally what happens is this. The market will trade to the major resistance area, which we looked at yesterday. And as I said in yesterday's market view, it has to break through convincingly. And what we mean by that is it trades through and then comes back and finds support at the 170. The selling disappears. The market trades sideways and then it starts to move higher again. But in this example you can see that the buying came in, no problem there, and then the market tried to move higher, and by the conclusion of this 30-minute bar you can see the volume is very large indeed. So that indicates that again this activity by professionals sucking the weak traders in, thinking, oh right, it's broken above now, we should be off to the races, and then of course the market turning around and coming back. The market traded back to the DP level. We can see a bit of buying coming into the market there. It's retested down in this bar here at midday, and then the market starts to move higher. We then get the buying coming back into the market, but unfortunately it runs out of steam at Friday's high, and then we see the selling coming back in again. So to mitigate the potential loss there, 50% below the bar that comes back through the entry price, and instead of having to sit on a potential 29 point loss there, we just have around a 10 pip loss there on this particular trade. So there's not a lot we can do. It's a bit of a funny day really, the market breaking through and then trading back and then coming back around 62% I think of the move by the looks of things there as well. So from the high down to the low, yeah, bang on 62, in between 62 and 76, and then drifting lower on the overnight and retesting yesterday morning's lows here as well. So the market attempting to move back up this morning, and on the European session there, just heading back towards yesterday's close. So down on the overnight and heading back towards yesterday's close at the moment. In the bigger picture we can see the 170 being taken out but failing to close above, and a bit of weakness on the overnight, which is now being bought back there by the institutions in Europe. You can see the market just coming up slightly there. So let's just mark up some potential downside targets. The upside target, of course, is going to be yesterday's high, which is 170.09. So let's just have a look at the potential downside there. We've got the 169.54, 169.42. So 169.50 is going to be a crucial area. If this is broken, we could see the market trade down to 169.42 there. On the news front today, we've got the CPI for the UK. It's forecast to be lower, so there is no inflation around. Your food prices aren't going up. Nothing's going up according to the government. Everything's going down. When these figures, for the last 6 months, according to what's been released, of course, we know that's different. And for many, many years, I've talked about two separate books where inflation is concerned, what we're paying and what the government has in its basket to calculate these funny figures that don't reflect reality whatsoever. So it is what it is. They are forecasting 1.7. If it comes out down at 1.7, then expect the market to move higher. The RPI, Retail Price Index, is forecast to be the same. We've then got 10 o'clock ZEW economic sentiment from Germany. This is forecast to be higher. And then we've got the core CPI from the US at 130 as well, to remain at 0.2. How on earth they get these figures, I do not know. There can't be any food prices in the US CPI anymore. Building permits out at 1:30 p.m. and then housing starts as well, which is a medium impact news item there. Moving over to the Dow, you can see that yesterday the market bouncing back, trying to come back. You can see it opened, traded lower, and then drove back up, heading back towards the 16,808, which it needs to break in order to move higher. If it's going to go through the 16,808, it needs to then go through the 16,841. Which is the high of the selling bar again, which we looked at yesterday. You can see this here. And then on to the 62 and 76. When we get to the 76 area, this is crucial. And how do we actually trade it when we get to this area? If you're in front of your computer, you can trade that by going into a smaller time frame, 5 or 10 minute chart, which I spoke about in the setup video. And if you can't be at your computer to actually do this, then you could always trade this on an end of day basis, which I will show you when it actually, or if it actually occurs at that time. That's what the market generally does, and we'll be able to tuck underneath the lows in this area should any potential weakness come into the market, but I'll keep you posted of that. In the implied volatility, we can see that this turned around yesterday and started to move higher with the underlying market, which is quite odd really. 10.19 for yesterday, which is, like I say, unusual that the market's moved higher, and so has the implied volatility. But that could be due in part to the fact that the market moved lower to begin with and then recovered and moved back to the upside. So that's probably what it actually is. And finally, before we conclude, you want to take a look at this. This is the central cluster of central banks have secretly invested 29 trillion in the market. This started out as a conspiracy theory, which has now become a conspiracy fact. It never ceases to amaze me that all of the alternative news providers on the internet are scorned at by the main media and told that they are conspiracy theorists. But it's amazing how eventually the truth comes to light. And again, this is now being confirmed by the FT reports. A cluster of central banking investors have become major players on world equity markets. The report, to be published this week by the Official Monetary and Financial Institutions Forum, confirms 29.1 trillion in market investments held by 400 public sector institutions in 162 countries, which could potentially contribute to the overheated asset prices. China's State Administration of Foreign Exchange has become the world's largest public sector holder of equities, according to officials, and we suspect the Fed is close behind, courtesy of more levered positions at the Citadel, as the world's banks try to diversify themselves and counters the monopoly power of the dollar. So what we've got here basically is that it's been confirmed that 29.1 trillion is public sector finances holding up the equity market. So there's no surprise really that we have this bubble in the market. And as it just goes on here, I'll leave you to read the rest then. While most have assumed that this is likely, the recent exuberance in stocks has largely been laid at the foot of irrational, uneconomic actor, the corporate buyback machine. And this is why you are seeing these low volumes in the equity markets. If I just change this to a monthly chart, I've covered this before, but let me just show you this again. You can see that the average line there is dropping off. This is corporate buybacks, and now we get behind what's really happening with the market, and that is that we find and discover that there is 29 trillion of public sector money being pumped into the markets to try and get a return because the interest rates are so low everywhere else. And this report is to be published this week, so we'll catch up with that later. But nice to know that once again the alternative media were onto this way before the mainstream media have published it or actually made the masses aware of what's actually going on as far as propping up the stock market is concerned. Of course, it can continue. 29.1 trillion is an awful lot of money to have in the market. It's it's very easy to stop any selling coming into the market, but at some point, as with all asset bubbles, they have to break. So it's a case of just watching the market on a day-by-day basis, bar by bar, and see how it unfolds. But we have got those lows in the implied volatility. Whether that still remains a valid signal sometimes is questionable, because when you've got a situation like this, and it's, I suppose, summed up really at the bottom here in this graph, when you see the stock market and the GDP expectations continuing to make new lows, and also the US was marked down last night as well there by the International Monetary Fund. Their GDP for this year, the figure was revised down. And I think really what it's, as it says here, to summarise, the global equity market is now one massive Ponzi scheme in which the dumb money are central banks themselves, the same banks who inject the liquidity to begin with. And that explains, as you see there, that graph. And it says at the end here, that said, good luck with exiting the unconventional monetary policy. You'll need it. And that's absolutely true, because once it starts to unfold, then it will be quite a scary situation to actually be involved in. And at some point, you know, the asset bubbles always burst. So it's just a matter of time, really. So on that less than cheery note, but one there, what can't speak can't lie as far as the graphs are concerned, this ends today's market view. All things being equal, I will see you in tomorrow's. Have a great day, and as ever, thank you for your support and also for watching.